From more, Jonathan Charley and Julian Skan. Julian's head of Accenture's capital markets practice for the UK and Ireland. Jonathan Charley, partner at Bearingpoint. Gentlemen, initial reactions. You first, Julian.
No major surprises. I think the government has put more focus on the risk aspect than on creating competition, recognising that that's a harder thing to do through regulation. I think the time frame is not a huge surprise because it allows time.
2019 we're talking about.
It's a long time, but you've got to remember that if we move ahead too quickly with things that are set in stone, we can't align to other changes other people make, which will increase the disparity in competition in us and other banking sectors.
Jonathan Charley, your initial thoughts on what you've heard so far?
Well, certainly, obviously, the 2019 was a slight extension over where people were expecting it to be. I think in terms of the competition, they've really fluffed the whole proposition. I mean, they basically said that the Lloyds sale of its branches needs to be kicked into the long grass until they've understood how it becomes more competitive. And they've been quite glib around how easy it will be to get transparency in retail banking and switching of accounts. So I think the real focus has been purely on the ring fencing, and the other parts of the report have really been ignored.
And Julian, is this ring fencing, the difference between retail and commercial, what's needed in your view? Is that the right way to go about things?
Well, it depends which lens you look through. I think in the round, the idea of a degree of separation is a good thing. There's been a lot of text that says, well, none of this ring fencing would have stopped Northern Rock failing, it wouldn't have stopped HBOS making the lending decisions it made in commercial. That's true, but it would have given the regulators and the government a different regime within which to manage the problems. I think how the ring fence is implemented, even now with the more detail we've got, is still up for grabs.
Well, they've got 9 years to work it out, haven't they?
Well, they have. I mean, an interesting aspect on this, we've looked a lot through the retail lens. If you look at the investment banking lens, which is an important sector, notwithstanding the systemic risk that it does pose to the economy, it is good if we are seen as a stable economic environment for new competition to come into the investment banking sectors from the Chinese or in time from African and Asian countries. So it is good if London is seen as safe. It's a balance that if you take the profit of banking down so far, people won't want to come in anyway.
Jonathan Charley, will this cost growth? Will this cost jobs?
Well, it's certainly got to be questioned as to whether it will impact growth. In terms of costs, it's clearly going to increase costs. And the question is how much of that is actually passed on to onto customers. But in terms of lending, will it reduce lending? Well, certainly in the longer term it might do, but obviously they've been given some time to implement it. So it's very much a political decision around the timing rather than a purely business decision.
And is this a real wake-up call, do you think, for the banks? Is this a time where they've got to wake up and start living in the real world? This is a new start for the banks, or is it actually, 2019? Just carry on as you were, really, at the end of the day.
Well, I don't think for any of the banks this is going to come as any great surprise. I mean, they've been aware of what's going on. I think what it will do is for some of the international banks, when they're considering that if this really actually happens, when they look at the location of some of their headquarters, they've got the chance now to say, look, if this is really going to happen, then we could consider moving ourselves out of London or some parts of our operations out of London.
Julian Skan, do you agree with that? Is that something that you really think is a threat that we've heard before, even from the likes of HSBC over the past few months, that is something that they would carry out? Because London's still the major European financial centre.
I think it depends on what other countries do, and I think it depends on whether banking can find a way from a return on equity of about 7% back to return on equity of about 15%, which is where the point at which you or I or a fund manager as an investor would want to put money into it. If it can't, there's no business. So, how much profit, how can you get the profit back without re-risking everything and creating systemic risk?
Final thoughts, just for now, gentlemen. We've seen huge falls in the value of banking shares. Has this already been priced in? Has a Greek default already been priced in? Julian first.
I don't think a Greek default has been priced in. There's too much uncertainty. I think the very low amount of profit for a sustained period of time in the sector has been priced in.
And I think we will obviously see once the markets open what the implications are. But I think probably for the likes of Lloyds, it's not going to be good news on the share price.
News crossing the terminal now from the British Bankers Association. They're saying that UK banks on the way to implementing the reforms already, and other news coming into this. Do you agree with that, Julian? Is that something that banks are really working towards, these full implementation without any sort of worries at all about the future? Jonathan, excuse me.
No, I mean, I think obviously there are some elements of the recommendations that are already in place. For instance, some of the banks already have a separate retail board. So some of those pieces they will be able to declare that they're actually already moving towards. But there are other parts that clearly the detail needs to be gone through in terms of what's in the report. And I don't believe they will have even started on some of those. And I think there will still continue to be negotiation with the government, because don't forget, the report is not binding on the government. The government has to decide how much of it it's actually going to implement.
Julian, let's go back to Europe. We heard Caroline Hyde, our reporter there, looking at those massive falls in valuations. To what extent are we staring a real European banking crisis in the face right now?
I think there is an increased risk that we are looking at another wave of crisis. I think the uncertainty in the ratings is driven by the uncertainty about how the politicians will react, rather than any new news about the balance sheet of any of the French banks. And of course, what we're talking about in pricing the assets on a bank's balance sheet is that it's a moving feast. The price depends on who would buy it if you wanted to sell it, and that can change if you get into one of these spirals where there's no longer a market for the debt that you're holding. So it is a moving feast, but I think the new uncertainty now is just how the political state of Europe can cope with the situation as it unravels, rather than any new news about the banks.
And the only buyers around, if you could put it in those terms, would be government buyers. Do you think we might see more nationalisations of private banks?
I think that's something that the governments are going to be very reluctant to do, and so I think we probably won't. It will be absolutely the last resort that they will want to bail them out further.
Let them fail?
Well, I think they would have to look at how they could let them decline slowly.
Do you agree with that? Is that something that governments actually would be prepared to see across Europe, whether it's in Spain or Ireland or other countries as well?
I'm not so sure, because for the same reason that it really wouldn't have been a good idea to let the UK banks fail. If you get a run on the bank, you get a consumer confidence issue on top of a markets issue, and that would be very damaging. I don't think any European government would want to see that.
What more support could be given to banks to help them out, those weaker banks on the periphery?
I think it's a longer-term issue, but I think if you go back to competition, there needs to be, actually in the UK and in parts of Europe, a bit of an amnesty, and take a look at the core profitability of banking. Banking needs to find a level of profit that the government and the public are prepared to accept, and then to work out a competitive structure where they can make money in a more transparent way. The root cause of some of the competitive and the risk issues is that bankers are forced to find ways to make money because we've introduced at the retail level free banking. And that is not actually a smart way to run a business like banking, in my opinion.
How much responsibility should some of these banks be taking for some of the mess that they're in?
In terms of what?
In terms of the profitability, in terms of the liquidity, in terms of actually turning to the government and saying, you know what, we've got no one else to go to, help us out or we go under.
Well, of course, certainly if you look across certainly the UK banks, a number of them didn't actually look to government help, albeit there was an implicit help from the government. If you look to the European banks, a number of those have really expanded very rapidly into other markets and therefore really have opened up their exposure quite considerably. And so you'd have to say it was the responsibility of those leading those banks.
Given what we've heard today from the ICB, also coupled with the Basel III capital requirements, do you think there might be some delay in implementing the Basel III capital requirements, or is it all going to come down on the banks over the next few years?
I think it's all going to come back down on the banks in the next 3 years. It depends on what sequence. I mean, look, you can always find a reason for putting another % on capital. We could go back to non-fractional reserve banking, where you had to hold exactly the amount of money that you lent out, and it will be completely safe. So really, it's a society question. How much do you want to bet on the future? I think the UK regulators will be adept enough to adjust to what Basel III does, so that we don't end up loading more and more and more and get in a completely uncompetitive situation.
Julian Skan, Jonathan Charley, thank you very much indeed for now.